Hey everybody, welcome back to the channel. In today's video, I'm going to be talking about my dividend portfolio allocation and diversification plan. I'll be talking about how I'm splitting up my investments among the different asset classes. I'm going to be talking about what percentage I'm allocating to each type of investment, as well as provide a detail of the exact investments I'm making and the percentage allocation on each. Also going to talk a little bit about my rules for my account, as well as the goals. Before we do that, I want to talk about what I feel like diversification really means. The traditional way of looking at it is don't put all your eggs in one basket. And this strategy involves spreading your money among various investments in the hope that if one investment loses money, the other investments will more than make up for those losses. And a 20 to 30 stock portfolio, properly diversified across different sectors, is probably sufficient for most people, but I look at it a little differently. Instead of having assets in each category, I'm looking at the diversification of my income itself. So if I only had 20 or 30 stocks in my account and one cut their dividend, that's a 4 or 5% hit to my income. But if I held 50 stocks and one cut, that's about a 2% loss of income. But as you can tell, if I had 100 stocks in my portfolio and one of them cut the dividend, I'm only looking at a 1% hit to my income. A 1% hit to your income is very easy to make up for through your other investments and dividend growth. When it comes to allocation, it's really about dividing an investment portfolio among different asset categories. So in my portfolio, I'm looking at things like dividend ETFs, closed-end funds, income funds, individual stocks, and real estate investment trusts. So before we do that, let's talk about the goals of this particular account. Now, this is my brokerage account. It does not include my retirement account. And the main goal for this account is to utilize the income to retire early with dividends by 2031. Because my shorter time frame, I am focused on current high income from the investments, and the dividend growth is only expected to be a moderate growth of around 7% compound annual growth rate. This allows me to beat inflation and provide increase in my income through the annual increases that the dividend companies and funds pay. And as I mentioned before, diversification of income sources is a primary goal of this account as well. So I did set up some portfolio rules for this account to keep me on track. The first one is that no individual stock can be more than 5% of the portfolio value. In reality, most of my individual holdings are under 2%, but I put this in place to ensure proper diversification and not to take on too much risk with an individual name. Also, no sector can be more than 15% of the portfolio value. So as you may be aware, there's 11 sectors in the S&P 500. We're talking about financials, technology, industrials, etc. And so no individual sector can be more than 15% allocation to the portfolio. If you invest in sector ETFs, those particular ETFs do count towards your sector limit. So if I had a financial services sector ETF, that would count towards my 15% maximum for that sector. But broad-based ETFs and closed-end funds do not count to the limits because themselves are properly diversified within the ETF and closed-end fund itself. I've chosen not to invest in any kind of energy stock or tobacco stock except for if it's already part of an ETF, but I'm not going to have any individual holdings in those two categories. And lastly, just to reinforce, the diversification of income sources is paramount to this investment strategy. So let's talk about the asset allocation. So in this portfolio, I have decided to allocate 30% of my portfolio to dividend ETFs, 17.5% to income ETFs, 17.5% to closed-end funds or CEFs, 10% to real estate investment trusts or REITs, and 25% to individual dividend stocks. Looking at the sector breakdown, you see it's properly diversified. Okay, so for the dividend ETFs, I've chosen to stick with 3 different funds. The first one is SCHD at 15% allocation, VYM at 5%, and VYMI, the International Vanguard Dividend ETF, at 10%. Looking at the particulars for the dividend ETFs, 33.33% is international, and 66.7% is US-based dividend companies. For the income ETF allocation of 17.5%, I'm also utilizing 3 funds. The first one is DIVO, DIVO at 7.5%. IDVO, which is an international version of DVO, at 5%, and JEPI, the JP Morgan Equity Premium Income ETF, at 5%. Breaking that down, 28.6% is in covered call ETFs, 28.6% is in international dividend ETFs, and 42.9% is US dividend income ETFs. So again, properly diversified across the different asset classes. For the closed-end fund allocation of 17.5%, I've chosen 4 closed-end funds to focus on. We have BDJ, the BlackRock Enhanced Equity Dividend Trust, BST, the BlackRock Science and Technology Trust, RFI, Cohen & Steers Total Return Real Estate Fund, and UTG, the Reeves Utility Income Fund. BDJ, BST, and UTG will have a 5% allocation, and RFI has 2.5%. Breaking that down, you can see there's proper diversification here as well, with utilities at 28.6%, dividends at 28.6%, technology at 28.6%, and real estate funds at 14.3%. So even within the closed-end fund sector, I have proper diversification to not put all my eggs in one basket. Now we're going to talk about real estate investment trusts. That's a 10% allocation to my portfolio, and I've allocated 1% to each of 10 holdings. We have Agri Realty, Apple Hospitality, Alexandria Real Estate Equities, CubeSmart, Hannon Armstrong, Invitation Homes, Realty Income, Simon Property Group, Vici Properties, and WP Carey. Breaking those down by the sectors that they invest in, 10% in experiential, residential, specialty, storage, office, and hotel, and 40% in retail properties. And lastly, the dividend stock portion of the portfolio is a 25% allocation. And these are the individual companies that I have chosen to focus on individual companies wise. Now, this is more of my fun portion of my portfolio, the ones that I am interested in following and doing research on and understanding the particulars of the businesses here. As you can see, no allocation is more than 2%. And this allows me to have proper diversification and not put too much risk in one individual company name. So as you see here, my allocation is Apple, AbbVie, Archer Daniels Midland, Algonquin Power, Brookfield Asset Management, BCE, Brookfield Renewable, both as the limited partnership and as a corporation, Brookfield Infrastructure, BlackRock, Cardinal Health, CVS Health, Duke Energy, Gilead Sciences, General Mills, Johnson & Johnson, JP Morgan Chase, Coca-Cola, Leggett & Platt, Lockheed Martin, MetLife, Manulife, NextEra Energy Partners, Pepsi, Pfizer, Starbucks, Toronto Dominion Bank, and Walmart. So these are my current allocations as of now, but this is subject to change in the future as new investment opportunities come up or if certain companies aren't fulfilling the need of my portfolio. So I'll be looking at these to augment in the future, but this is where I'm at right now. And I feel very comfortable having these allocations at the percentages they are. Again, this is going to be 25% of my total portfolio. So I am utilizing the ETFs and CEFs as the majority of my portfolio. And individual dividend stocks is kind of like a satellite positionings. Okay, so looking at just the individual stocks, the diversification is across 8 of the 11 different sectors. So we have industrials, consumer discretionary, communication services, financial services, utilities, consumer staples, healthcare, and technology. As you can see by the percentages, it looks higher than what I had mentioned that part of my rules are, and that's because this is only looking at the 25%. If you include those individual companies in the larger portfolio, including the dividend ETFs at 30%, closed-end funds and income funds at 17.5%, and real estate at 10%, the individual sectors on the individual stocks is healthcare at 4.5%, consumer staples at 3.5%, utilities at 5%, financial services at 8%, communication services at 1.5%, consumer discretionary at 1%, and industrials at 1% as well. So again, I'm staying within my portfolio rules and also providing proper diversification across the board. So to recap the portfolio, I'm going to be throwing 30% in dividend ETFs, 17.5% in both income ETFs and closed-end funds, 10% in real estate investment trusts, and 25% in individual dividend stocks. As you can see, 65% of the portfolio is in funds, and the remaining 35% is in individual names. I'm utilizing the ETFs and CEFs as my baseline of my portfolio, and then utilizing individual stocks to one, follow and enjoy the process, as well as providing some potential upside having individual names. Thank you very much for watching. Really appreciate your time. Please subscribe if you haven't and click the like button if you found this enjoyable. Please visit us on social media at Div Stockpile on Twitter/X, or visit our website at dividendstockpile.com. Really appreciate you coming. And while you're here, please click on the video that's popping up on your screen to look at more content. Thank you, appreciate it, and have a great day.